Bloomberg Audio Studios.
Podcasts, radio, news.
This market got the dovishness it wanted to hear. The equity market's positive by close to 2% on the S&P 500, on the Nasdaq 100 up by 3.3. We're moving closer to cutting interest rates. September could well be on the table. Push that through the bond market, a fifth consecutive day of gains for the 10-year Treasury. Yields lower. We're down by 4 basis points on a 10-year. It's a break of 4.1%. So we've all got the same question. Just how low is the bar for a rate cut in September? This is what the chairman had to say.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So let's talk about the calendar. The next meeting, September 18th, the data in between. August 2nd, this coming Friday, payrolls. August 14th, a CPI report. September 6th, the jobs report. On the 11th, another CPI report going into a Federal Reserve decision week. And most people assuming after that, Lisa, we're like this far away from that interest rate cut.
Especially at a time where there was a different type of language in this communication. We are not data dependent. They are data dependent. They're not data point dependent. They want to draw a distinction that one data point isn't going to throw them off materially. They repeated the totality of the data as well as how they just need to see the same kind of good data that they've already been seeing.
The time continuum to me was critical. I thought Steve Leisman's question was great about measured. He alluded to this. They're slaves to measure, John. That's all there is to it. I just don't know what else to say. I'll talk to Dudley about it here. To have Clarida and Dudley with us today is
fantastic.
It's just lights out. And I really, for those of you at Global Wall Street, what's coming up here with Dr. Dudley is required listening.
There was a fantastic line that came from Evercore's Krishna Gua. I want to share this quote with you. He thinks they've laid the foundations for a rate cut in September. I think a lot of people observing that news conference would agree. But this quote's interesting. We think in practice it's not very data point dependent and view the cautious evolution of the statement as intended to carry hawks along and avoid dissents, as was indeed the case today. Expect a clearer signal a month from now at Jackson Hole. I'm thinking about the minutes as well. I just wonder how well set the stage is for the Doves to dance and sing very loudly in these minutes that come out in a number of weeks' time.
I was very happy that the reporter asked him to elaborate on the fact that at this particular meeting, they did discuss the possibility of cutting rates, that there were a few members, but not the vast majority. Here is the question. How loud was that voice, and what did they have to give to those people to get on board with them in terms of this decision?
As you bring in Dr. Dudley, moments ago, the 10-year yield broke down to a 408.92. It's a new low yield. Can you imagine, John, what our shows are going to be like with a 399 10-year? I can't get there.
Where are we going to be in September? Where's the unemployment rate going to be in September? That's the big question I have going into the payrolls report this Friday. Bill Dudley got a shout out in this news conference. Bill Dudley joins us now, the former New York Fed president and Bloomberg Opinion columnist as well. Bill, I want to go to your column that you wrote in the last week or so. It was quoted in this news conference. I'm sure you heard it. What did you think of the chairman's response to it?
I thought it was a fair response. I mean, this is my opinion, and the Fed is reaching a slightly different opinion. I mean, we're at a point where the risks are pretty closely balanced, and so the question is, do you go a little earlier or do you go a little later? I think, the reason why I thought it made more sense to go is that if the market's already pricing in September with a high degree of certainty, what are you really waiting for at this point? Why take the additional risk of, the economy deteriorating further? So, at the end of the day, it's probably not going to make a lot of difference. But I think, given the fact that the market expects the Fed to cut, once that decision is mostly made, and I think you heard today it was mostly made, then why are you waiting?
Bill Dudley, your essay heard around the world, the single sentence, the Fed doesn't want to be fooled again. You've held court at Princeton, where the late, wonderful Daniel Kahneman held court. Here's Kahneman with Tversky. Decision makers know they are prone to regret, and the anticipation of that painful emotion plays a part in many decisions. How is regret aversion playing in to this massive data dependency ex post ballet?
Well, what may be happening here is the fact that they got fooled on inflation, early this year, where the data came in bad, makes them overly cautious that they're going to make this, that they could make the same mistake again by going early. I think it's, economists talk about recency bias. You put too much weight on the most recent experience. So this may be a case where they're not putting enough weight on the fact that, things are slowing and the inflation's coming down, and maybe now's the time to act. I think it was interesting. You got a question about the SOM rule, that the fact when the unemployment rate climbs above 0.5% on a 3-month moving average basis, you always have recession. He said he's aware of it, but clearly the Fed doesn't put a lot of weight on that risk.
Do you feel like we're getting closer to the moment where we will see real dissent on a committee that's being cobbled together, and you can kind of feel the strains in some of the communiques?
No, I think what happened today was basically the Doves got a pretty dovish statement and a pretty dovish press conference, and so they're sort of set on board, and the Hawks got more patience. And so when you arrive at the September meeting, assuming the outlook doesn't change in a material way, and that's basically what Powell was saying, it's not about a single data point. The outlook has to change in a fundamental way for the Fed not to go in September. At that point, you have something to basically give to both the Doves and the Hawks. The Doves, thank you for being patient. The Hawks, we waited. So let's go together unanimously at the September meeting. So I think it's a good possibility that you'll see a unanimous vote at September for a 25 basis point rate cut.
Bill, you brought up the SOM rule. The chairman also brought up the yield curve in this news conference as well, and highlighted the false positives we're getting from traditional indicators. Just to reflect back on that piece that you wrote for Bloomberg Opinion, can you walk us through why you do think actually the SOM rule does matter? That maybe we should have a little bit more of a focus on these traditional indicators still and not completely ignore them?
Well, if I can start with the yield curve, the reason why I don't think the yield curve is necessarily a good predictor is the yield curve is inverted because people think monetary policy is tight. So it's not the yield curve shape that causes the economy to weaken. It's the presumption that monetary policy is restrictive that causes the economy to weaken. Most of the time when the yield curve is inverted, monetary policy is tight, and so the yield curve is a good predictor. The SOM rule, I think, is a little bit different. It's basically saying once the labor market deterioration goes beyond a certain point, it becomes self-reinforcing. Essentially what I think happens is households hear about the labor market weakening, they pull back on their consumer spending. That causes businesses to pull back in terms of investment and hiring, and that leads to further weakness in consumption and then further rises in the unemployment rate. It's a pretty amazing statistical regularity that either rises less than 0.5% or next stop is a full-blown recession. There's nothing in between. The smallest increase in the unemployment rate, trough to peak, is either between 0.5 and 1.9 percentage points. There's nothing in the middle, which I think is pretty interesting statistically. Now, he did recognize that as a statistical, just a statistical result. There's no economic law behind it. But the track record is 13-0. So, think about the odds of flipping a coin 13 times and coming up heads every time. After a while, you're sort of going to believe that the next flip is going to generate the same result.
Bill, take us back to first principles. Why can't they just cut and say one and done and we'll observe versus our addiction to measured?
Well, I think what will happen is once they start to cut, they'll probably keep going. Once they start to do the first rate cut, they basically decide that monetary policy, that we've accomplished our mission in terms of inflation and unemployment. Policy is restrictive, so we now have to go back to neutral. Neutral's not 25 basis points away. So if you have a rate cut in September, it's probably going to be followed by rate cuts, at least one or two more rate cuts later this year.
Bill, it seems like this was a setup for Jackson Hole. We've been talking about that. And it seems like there will be some sort of policy regime shift that we will observe in August. What do you think it will be?
I don't think that Powell really needs to say much more than what he said today, frankly. I mean, I think the changes in the statement and the press conference today basically tell you that September is going to happen unless the economic outlook changes materially. Now, that's possible. You could get a whole string of bad inflation numbers, or the economy could come in hot. But I think in the next 6 weeks or 7 weeks, is the outlook going to change materially? I doubt it. So I think regardless of what happens in Jackson Hole, I think the Fed's going to cut in September. I think, Powell will sort of check in at the Jackson Hole and basically, probably confirm that we're still on track for this result for rate cut in September. But I don't think it's, I don't think he has to use it for that.
Well, although it's not just about September, it's not just about whether they're going to move again one more time this year. It's about what the destination is. It's about the pace. It's about what the goal is in terms of just the view of where the economy is. Bill, do you expect there to be any discussion about the terminal rate, about what it means to be neutral at a time where this is a very different economy than pre-pandemic?
Well, I would assume that once you get inflation, you're highly confident inflation is going back to 2% and you think the labor market's in balance, then you presumably want to go back to a neutral monetary policy. And the question is, what's neutral? And that comes down to that whole question of what is the level of R-star, the neutral federal funds rate. I think that neutral is clearly, lower than where we are today. But is it 100 basis points lower or 200 basis points lower? That remains to be seen. So the Fed's going to be sort of feeling its way. Now, obviously, if we fall into recession, then the whole story changes. Yeah. Because in a recession environment, the Fed doesn't want to go to a neutral monetary policy. They want to go to a stimulative monetary policy. So if it turns out with the benefit of hindsight that the Fed is late and we have a mild recession, then the Fed's going to cut rates much more dramatically.
Bill, I've never said this. I've got Dudley, Krugman, and Blinder on the same page. Never did I think I'd say that. The money paragraph from your good friend Alan Blinder. Any such early cut should be accompanied by a warning not to expect a steady stream of rate cuts. He alludes to the ECB. Do we need some ECB religion at the Eccles building?
No, I think that the Fed will probably cut more than one because once you start to cut, you're basically saying, I think it's time to remove monetary restraint. And monetary restraint is not going to be removed with just 125 basis point rate cut.
Bill, great to get your thoughts. Appreciate it.
Fabulous.
Bill Dudley there, the former New York Fed president, weighing in on this Federal Reserve decision as he got a lot of people talking over the last week about the need to move in July at the meeting that's just passed. I want to bring you a headline. Comes from the New York Times and it reads as follows. Iran's supreme leader ordering a retaliatory attack on Israel. The New York Times citing 3 Iranian officials briefed on the order. This is what I can tell you about crude. Crude's been rallying all day, and the price of crude looks like this at the moment. Brent crude up by 4 percentage points. TK, you would often say overtaken by events. The last thing this Fed needs over the next month or so is an energy price shock.
I'm so glad you brought this up, Jan. We led off the show this morning with Ethan Bronner, our Tel Aviv News Bureau chief, encyclopedic on the region. And he says the position here now is unprecedented. And he made clear there's going to be immediate news following both from the north to Lebanon and the news that you just have from Tehran as well.
As we get those updates, we'll bring them to you. I just want to reset. If you are joining us, we've just had a Federal Reserve decision in the last couple of hours. Interest rates unchanged. Incremental changes to the statement. There was a sense that in September, the Federal Reserve chair would set us up for a rate cut in September. He took a baby step towards doing so, and the market picked up on things accordingly. Big rally across equities, on the Nasdaq, on the S&P, on a Russell. It looks like this right now. It fades just a touch, but we're still higher by 1.4% on the S&P. Bear in mind, the Nasdaq was poised for the worst month of the year, and at one point in the last couple of hours was on course for its best day of 2024. That fades. We're back down to about 2.7% higher on the session on the Nasdaq. We referenced this stat a little bit earlier on today, a few times. We are now on course for the 7th consecutive Fed decision day rally on a 2-year bond. Lisa, that yield is lower by 6 basis points.
How much is this just that Jerome Powell tends to skew dovish, and how much is this that the market still has a probability or a possibility baked into what the yield is that the Fed could maybe surprise in a hawkish manner? Either way, this is a market that likes to hear Fed Chair Powell speak, and today was no different.
Mike McKee was in the room with the Federal Reserve Chair down in Washington, D.C. He joins us from the nation's capital now. Mike, you've just got outside. Walk us through your biggest takeaway from that news conference this afternoon.
Well, I think what you walk away with is what Bill Dudley was talking about. If the economy doesn't do something weird, change positions, change directions, then the Fed is going to be cutting in September. But there are a lot of potential twists and turns between now and then. Friday is event risk with the jobs report. And of course, you just mentioned the situation with Iran. I don't think the Fed was taking those things into consideration today as reasons not to move today, but they do have to worry about them and what might happen. Right. So they will, at this point, be on a cutting course unless something significantly changes. And I think that was the message that Powell wanted to deliver. And I think Bill put it well when he talked about how the statement was skewed to the doves a little bit, and the news conference maybe to the hawks, and that both sides get something out of it.
Mike, you've been doing this for a few years. Back to McChesney Martin. We almost printed a 406 10-year moments ago. Can the bond market tell the Fed what to do?
Probably not. And one of the things that you have to keep in mind is that we have all this international news going on, and the U.S. bond market is the haven market. So a certain amount of what's going on today is probably in reaction to Israel and Iran. And a certain amount of it is the politics going on in this country. And then on top of that, what the Fed is considering and what the economic data are showing. But I suspect today's less about the Fed and the data than it is about other things, because the market had pretty much priced for a September rate cut. They didn't get any surprises out of the Fed today.
Mike, you're referring, of course, to the news that John broke about Iranian supreme leader ordering an attack on Israel for the two assassinations that Israel carried out. Right now, we're seeing crude markedly higher, particularly Brent crude. Mike, I wonder how this relates to what Fed Chair Powell has been talking about, that this is actually better inflation data today than it was, say, late last year or earlier this year, simply because it is not being driven by goods. It is being driven by the employment market. It is being driven by services. How much do you believe, based on those comments, this is a Fed that is willing to look through good side inflation and focus much more on something else?
Well, I think they are, especially if oil prices go up only temporarily. The problem is if oil prices go up for quite some time, then that feeds through into the real economy, particularly on the services side. You'll see surcharges by delivery companies, airline fares might go up, that sort of thing. So they're going to have to keep an eye on that. But their general instinct would be to look past any kind of energy price change that comes about that they think might be temporary. And at this point, we have been waiting for a major shift in energy prices since October 7th, when the first attack on Israel came. So we haven't seen it yet. Let's see whether this holds or not. And then the Fed would have to take it into account if it's still going on.
5% rally in crude today. Mike McKee, great work as always, sir. Appreciate it. We'll catch up with you a little bit later. This week's not over. Still got some work to do. The Fed decision behind us. Tomorrow, we'll get jobless claims. On Friday, we'll get a payrolls report. And we'll be catching up with Jeff Rosenberg of BlackRock. We can do that now. Jeff, at 8:31 on Friday, will this decision today to do nothing, will that look like the right one?
Well, it might look like the right one, but I think the point you're also getting to is that Friday, and we'll see on Friday as well, is going to be much more consequential. But I think the important point about how it's going to be more consequential is what we've heard from everybody so far, what we heard from the chairman, and in the statement is this is very much setting the table for September. And the bond market had already priced that outcome. And so what you look at into Friday and the payroll is you're setting up the bond market, perhaps broader markets, for a very asymmetric outcome. If the data is much, much stronger, then you're going to have some disappointment. If the data comes in along lines of what Chairman Powell was talking about in terms of gradual normalization, or even a little bit weaker than that, the market will continue to price in this path of a cut in September, a cut in December, and even more into 2025. So I think Friday, the risk is really on the upside that you get a surprisingly strong payroll report, and that has to call into question whether or not policy is really as tight as it is. And that's really the issue. Everyone's kind of saying, hey, this is right. The Fed's got it right. The Fed's saying we've got the soft landing. We want to secure the benefits of soft landing. But he kept repeating PDFP at 2.6%. You look at the GDP number that just came out. You look at Atlanta Fed GDP Now forecast for third quarter. We are well above, in growth terms, anything associated with long-term sustainable growth. And so, yes, we've seen some signs of restrictiveness, but how much of that
Hold
restrictiveness?
Up, Jeff, because you're
and that's
going
where the asymmetry
totally
comes
against
in.
the grain. Totally against the grain. And I think you are. Most of the people coming on this show right now, if they're going against the Federal Reserve, they're saying it's because they think this Fed is too tight, not restrictive enough. You're making the point here, Jeff, that maybe they're not as tight as they think they are. Now, that really goes against the grain, Jeff. Is that the point you're trying to make?
That is the point exactly that I just made. No one's really talking about it because the Fed's not talking about it. But the data is what your question was about. What happens on Friday and how does that make this moment look? Well, if the data comes in continually stronger, then we're going to have to start to talk about that. Now, I'm not saying that that's where we're going. Where we have been, and what we tend to do is to extrapolate where we just have been. So we're extrapolating out the benefits of the gradual slowdown in labor markets, the normalization. ECI is another great data point. There's nothing in the crystal ball that says that that won't happen. But your question was, what if it does? Then you start to think about these things. And my point is, everyone is so one-sided on this point that the asymmetry to the market reaction is much greater to the upside surprise and strength on Friday than it is to coming in line or even being weaker.
So let's put a call around that, Jeff. Are you basically selling 2-year notes right now, trying to lock in because you think that this could be the highs, given that they are not recognizing the risk of an upside surprise to the jobs report?
No, I wouldn't say I'd go that far, but what I would say is it tempers some of the enthusiasm for adding to 2 years at this point when it's all in the price and even more so relative to what the Fed is saying that you're going to get. So the bar is a little bit higher to what do I do with this information in my portfolio when you look at, well, you know, the bond market's really quite priced a lot of that in. So it makes it a little bit more tricky than just saying, oh, the Fed's going to cut rates and I should back up the truck and buy a whole bunch of duration. Well, a lot of that trade has happened in the last month. So if you're just talking about maintenance cuts and the degree of maintenance cuts that are required, is what you were talking about with Bill Dudley a minute ago. We don't really know where that neutral is. So how do we know where neutral is? You know it when you see it, meaning you know it when you see it in the data. So if the economy doesn't slow and that unemployment rate doesn't continue to rise, and it says you're not so restrictive as you think you are. And I think, you know, we just kind of have a pile up on one side of the debate here when the data is still saying 2.6% PDFP. He said it twice during the press conference. He also said the other thing that has been supportive of restrictiveness, interest rate sensitive sectors and the slowdown in the labor market. But it's a more balanced view around this debate around how restrictive we are than where the market is kind of lining up. And that sets up an asymmetry to the outcomes.
Jeff, you're a great student of history. And if we have the headlines that John Ferro was talking about there of Tehran and Israel, and for that matter, up to Lebanon as well, how far out the full faith and credit curve does politics, does war, do our fears play in? Is it short term? Is it out to the 2-year pinch? Or is it out even further to the 10-year note?
So I'm going to frame that in that question, or my answer to that question, in terms of how does the kind of flight to quality response in the bond market play out in this environment. I've said this on the show maybe a couple of times. We've written about it. That flight to quality during the QE zero interest rate policy environment was a curve flattener. If you're very close to zero rates in the front end and you're looking for portfolio protection, you buy it in the long end. Today, we're in a very different environment, 5.25 to 5.5. There's plenty of room for the front end to go down. And so it's more of that pre-GFC kind of bond market reaction where flight to quality is a steepener and it's in the front end of the curve. So I think you see the most powerful reaction. It's hard to disentangle the high frequency between the news that Jonathan broke and the result of the press conference, but you do see a little bit of a steepener move into the market. Again, hard to disentangle the two, but I think when you take a step back, flight to quality now is the steepener trade, and your better yield response is going to be more in the front end in this kind of environment.
What's interesting to me today, Jeff, is what's not rallying on the heels of some of those headlines, especially in light of the Fed's dovish tilt, yes, but they did not cut rates. It's that the dollar is not catching a bit. It's weakening pretty dramatically. You're seeing the Bank of Japan very happy today. They're getting what they wanted in terms of a little bit more yen strength. How much is this sort of the new narrative that in a flight to safety type of moment, if the Fed is going to cut rates and not recognize that upside risk, you will see persistent dollar weakness heading into next year?
It's a tricky one, Lisa, because, on the one hand, you've got kind of interest rate differentials driving some of those dollar moves, clearly with the yen, balanced against the other side of flight to quality, which is the pure risk-off trade, is usually dollar strength. You go for the strongest institutional protection in terms of wealth, and so. I think initially the move is much more about interest rate differentials, and that's why you're not seeing so much of the move on the dollar. I think it's too soon to say whether or not you're going to see a bid to the dollar from geopolitical risk. But I think if it was a larger issue that spreads, you're going to think more traditionally that's going to be dollar strength.
You got to jump, John, and gold up $41.
Got a big rally in the bond market too, and equities as well. Jeff, just final question before I go. There's people watching, listening to this program right now. They just want to know, can I buy the S&P 500 and take a vacation? Is there anything to worry about between now and September?
Well, you never want to say take a vacation.
No.
Buying equities, you've got some risk. But you take the totality of what the chairman went over. And this is a lot of good news. I mean, this is a chairman basically saying, without saying it, we've achieved the soft landing. That's a great outcome for the equity market. It's a great outcome for the economy. It's a great outcome more broadly. So I think that's the takeaway, and generally that's going to be pretty supportive. I think the other thing just to mention, obviously, you're not really buying the S&P 500. It's not the economy. It's a collection of stocks that has a very high weight to a secular technology theme, and that secular technology theme is playing out again today following Microsoft's earnings, and you're seeing a bid back to semis. So you've got like the micro story there a lot, as well as the policy story. And we got to keep that in mind when we're looking at this high frequency data. And if you're buying the S&P 500 with a very high historical share to tech, it's really also buying into that tech story as much as it is about the macro economy.
Just trying to take a vacation. Jeff, appreciate it. Jeff Rosenberg there, BlackRock. Jeff, thank you. Deeply thoughtful stuff. Going into payrolls on Friday. We should share with you the numbers that we're looking for on Friday. Just another sneak peek of the payrolls survey here at Bloomberg. The median estimate is 175 on Friday. The previous number, 206. Unemployment coming into focus much more for many of you, I know. So here's the estimate for unemployment, 4.1%, in line with the previous month of 4.1%, Lisa.
And the reason why it matters, that unemployment rate, possibly more than anything else, is because if it gets to 4.2%, it triggers a SOM roll. Bill Dudley talking about why that's important. At that point, historically, it becomes a self-reinforcing mechanism of weakness.
The difference is you and I are taking vacation like 18 hours. Pharaoh's taking 18 days. That's the difference here.
Actually, I'm missing Friday because I'm going to be on vacation.
Thank you.
You're missing job say? It's un-American.
It had to do with kids' schedules.
Look, as a manager here at Bloomberg.
Blame it on the kids.
As a manager here at Bloomberg.
Are you going to blame it on the kids?
I track everyone's vacation.
Oh, do you?
Oh,
absolutely.
Yeah, is that correct?
You've both taken much more than I have.
Oh,
okay.
Please.
Just for the
record. Do you
record.
have a bar chart of it?
I do. At home, it's a spreadsheet. I load up the Bloomberg terminal and I'm on a vacation at the same time.
That's such productivity.
Missed this, haven't we? Appreciate it. It's good to see you, TK.
Yeah, please.
Thank you, sir. Lisa, thank you.
Thank you.
Are you going to bless us with some of your criticism of the Federal Reserve tomorrow?
Yes, I'm going to have commentary that blesses them very frequently.
Is there an auction tomorrow?
No, but there
That's
is
the line of
plenty
the press
commentary.
conference. That really
was.
is.